Risk. Let's talk more about that. Jim Paulsen is the chief investment strategist at Wells Capital Management, where he helps oversee $375 billion. He's here to discuss why fear and doubt, as he says, have become positive forces in the market. Boy, Jim, welcome. Talk about fear. Characterize first, if you will, today's market sell-off. Do you agree with the consensus that basically the gains we've seen of late are just a bear market rally?
I guess I don't, Lori. I think that we're clearly past the worst. We're probably exited recession last quarter, and we're starting a fresh recovery, and this is a new recovery rally. Doesn't mean it moves in a straight line. None of them ever do. And in fact, it's probably healthy to have pullbacks along the way, keep everybody honest. But I think we've turned the corner, and I think we're early in this recovery, both in the economy as well as the market.
So do you expect this sell-off then to be ephemeral?
Well, I think I'll let the market figure out whether they want to have this be a 2-month affair and 10%, or whether they're going to have it be a 1-week affair. If you're a trader, you got to work through those things and try to take a stand. But if you're an investor, I think you want to stay focused more on what could happen here over the next couple of years as this recovery matures and as people come to accept that we're back in recovery. And I think if you do, that there's still a lot of upside here, whether that takes off again this week or whether it takes off in a couple months.
So, Jim, let's address this note you have about excessive fears being an asset for future economic growth. Explain that further.
Well, I think in many ways last year this crisis was the impact that fear had was outsized in this crisis. Every crisis has fear as a bad thing. This one had a lot of it. And I think we could blame fear for a lot of the speed and the depth of this recession that we had. If you look at policy officials, for example, a year ago, their fear was palatable. It made me scared to watch them. And it froze me in my tracks, and it froze a lot of other people. Now, because they were so scared, they probably over-eased. We've got so much policy stimulus that come about a year later here in September and October and beyond, we're going to probably get a bigger lift than we probably would have had that not been so fearful.
But Jim,
if you look at businesses.
Jim, what about household debt load? What about the fact that people, even with the numbers and the internal signaling that we may have turned a corner, people still are not spending. People are still saving their money at record levels because they don't know if they're going to be the next one to lose their jobs, at least those who are working. What about the debt levels?
Well, I think it's interesting that people are suggesting we should have, they're concerned about the first quarter or second quarter earnings season because there was lack of sales, and they're concerned about the consumer because they're not spending. And we just exited a recession. Maybe 30 days ago, and we're at the bottom of a recession. We're still having job loss. I would not anticipate that there would be great consumer spending right now, but that doesn't mean that 6 months from now or a year there might not be when we're back with positive job creation. One thing I do see, Mark, happening is I see the healthy consumers that were frozen in their tracks, let's say last fall, and quit spending for a while, even though they had a job. They're starting to come back to some more normal spending behaviors again, and that's why we're seeing some green shoots. What we haven't seen yet is any really fallout yet from the policy medicine we put in place that should help the impaired consumers, those that did lose their jobs and did lose their homes. They've had severe restrictions in spending, but maybe if we create jobs again, that could start to come back as well.
And Jim, just give our viewers and our listeners a sense of how important it is for this spending habit to kick up and how important that is to growth, to GDP going forward.
Well, it's important, but my feeling on looking forward for growth is I share the view that consumption growth will be weaker than it has been in the past couple of recessions, but I don't think that necessarily means that overall growth is going to be weaker. What I see happening, if you look at the 90s expansion or even the one early in this decade, we had about 3% growth in real GDP. That came about from 3% from the consumer. It came about from 1% from business, and then we lost 1% through the trade window. If you look forward, let's say consumption really slows down. Let's say it only delivers 1% growth, which is what a lot of bears are saying. But if we get 1 from business and we get 1 through the trade window, guess what? We're going to grow about the same 3% rate we grew at in the past. Very different composition of growth, perhaps, more trade-related, less consumption-related, but nonetheless the same growth rate. And I think there's real possibilities that maybe consumption slows from 3 to 2, but we pick up a little more from business spending after a decade of no big cap spending, and we pick up positive trade flow rather than negative, and we end up with about the same growth rate we've had, which right now people are pricing stocks and bonds for something woefully less than that, and I think we're going to be surprised by the outcome.
Now, Jim, getting back to the theme of fear over the recession may be coming to an end. As you detail, we're probably coming into the early stages of recovery, but there's still a lot of fear and uncertainty, obviously, about the stock market. So how would you then suggest, what's your advice for playing the markets? What should an allocation look like for an investor, not a trader?
Right. I kind of like the fear, Laura, in the stock market. I mean, I think it tells me you got a lot of people sitting, they're under-allocated stocks yet. They can still come back in and be converted. They probably got a lot of liquid buying power on the sidelines here, and we still got policy officials trying every day to try to get the stock market still higher. And I think those are a wonderful combination. I think you've got to go where the profit leverage is, and the profit leverage is in the cyclical areas of the market. The areas that were forced to downsize in this last recession were the basic materials, the industrials, the consumer cyclicals, technology, and those are the areas that are now lean and mean and will have tremendous profit leverage as sales return. I don't think you can go to the steady Eddie consumer staples or healthcare or utility stocks and expect to participate in an earnings-driven sort of recovery rally that we're now getting ourselves into.
Jim, you still seeing strong profit leverage in the business sector at this point?
I do. I think what we've had this year, Mark, if you look at it, we had a first quarter earnings season that outpaced people's expectations. Now we've had a second quarter earnings season that outpaced people's expectations. And I think we're doing this on the basis of margin enhancement because we've got our corporate sector so skinny down and lean and mean because they were preparing themselves to live through the second coming of the Great Depression. And if we don't have that, we're going to find out that when dollars of sales start to show up, a lot of that's going to disproportionately fall to the bottom line.
Right.
And I think we've got tremendous earnings recovery forthcoming here as sales return.
And
that's a good place to leave it.
Yeah, Jim, thank you so much. Jim Paulsen, Chief Investment Strategist at Wells Capital Management, joining us from Minneapolis, Florida.